An absolutely fundamental concept in the world of finance is the opportunity cost of capital, which is defined as the amount of money a company must pay to fund its project. You can simply think of it as the cost of money. So the opportunity cost of capital defines how much money a company must forego to fund its investments. Understanding this allows companies to compare the potential return on a project versus how much it actually costs to fund the project. Okay, to bring clarity to this topic, let's revisit the financial cycle in the context of capital markets. The financial cycle describes the flow of money. There are two major parties, savers and companies. Savers give money to companies. The companies, in return, send back to the savers returns in the form of either profits gained from the company's operations or interest paid on their debt. The cost of acquiring money from savers, therefore, is the cost of capital. It is determined by a number of factors, but primarily is determined by the return that savers demand in return for their investment. Therefore, the return that the savers demand is the cost that the company must pay. If a company has to pay more money to fund a project than will be actually returned from the project, it's not worth it. If a project is more expensive to fund than the money returned, it's going to generate negative economic value. So the reason why this diagram is important is because the cost of capital means different things depending on what side of the financial cycle you're looking at. Therefore, let's broaden our definition of cost of capital. For companies, it is the amount of money that the company must pay to fund its investments in the form of either profits or interest. For investors, the opportunity cost of capital is the return an investor forgoes when taking an investment of equivalent risk and return, since the investor could have invested that money somewhere else. Typically, the opportunity cost of capital is determined by an organization's accounting department, so you will rarely have to calculate it yourself. However, let's just review how it's calculated from a high level so you understand roughly where it's coming from. Companies typically fund their operations using a mix of equity, which is bought by investors, and debt, which is lent by banks. Equity is actual ownership of a company, with a claim over the assets and profits of a company. Debt is just borrowed money that accrues interest over time, just like a car loan or mortgage. These are two ways that companies get funded by savers. Therefore, the cost of capital is calculated by creating a blended average of the costs associated with debt and the costs associated with equity, because typically companies use both. This creates the weighted average cost of capital. However, people just use cost of capital for short. And here comes the zinger. In a corporate context, we use the cost of capital to discount our future cash flows. From this point forward in the course, we will be using the cost of capital as our discount factor, because most investors' next best investment opportunity is often not just limited to interest earned on a savings account or bond, but could be any other investment on the market like stocks, real estate, commodities, and cryptocurrency. So using the cost of capital is just more realistic. One last note. You may have noticed that I use discount rate, interest rate, and the cost of capital interchangeably. Depending on the problem we're solving, interest rates and cost of capital are our discount rates. Discount rates are just the rates we use to discount our cash flows. However, the difference between an interest rate and the cost of capital is that the interest rate is a quoted rate in the market, while the cost of capital is the return on an investment of a similar risk, which is determined by many other factors. So the cost of capital is just more complex and more precise at determining a discount factor. They are different in nature, but similar in terms of the way that we use them to discount our cash flows. So don't get freaked out if I'm using them interchangeably.